Welcome to the Journey with Christian Evans podcast and Andrew Morali at Pax Fortis Family Office. Guys, we're going to be diving into some really interesting deal flow and topics and macroeconomic trends that are going on right now, and how, as investors and investors that we work with, from family offices that manage $25 million to $15 billion, what are they looking at? What are they looking at, and how are they really allocating their capital during these crazy times? So we're going to dive into some really interesting things. Andrew, how are you doing, my man?
I'm doing well, Christian. Thanks for having me on again. It's been a pleasure to get to know you and to launch Pax Fortis alongside you. I'm excited about what we're building, and we've got some interesting topics to discuss today that I think are very relevant to the market. We'll be talking about debt allocations and down rounds, which is kind of the faux pas word around venture, but it's happening, and so I'm excited to get into that discussion today with you.
Yeah, and I think one of the things, because this is going to be our first episode of the actual Pax Fortis as together as a combination, which is exciting things happening. We're already working on a really cool deal. We've already got amazing conversations with a lot of our network, a lot of synergies, a lot of excitement, and we're really looking to explode this and really build this out. I was curious before we dive into our first like several articles. Something that was top of news within the last few weeks really is the president of the United States, or former president of the United States, Donald Trump, actually spoke at a Bitcoin conference, which is very important because, again, what we've seen at the beginning of this year is institutions like the BlackRocks, like the Vanguards, are actually playing in. We're seeing that right, like coming down, which is like the first time ever. Institutions are playing in the Bitcoin crypto space, and then we're
Yeah.
seeing where it's solidifying the importance of this by having a former president speaking at a conference, right? So again, just solidifies the importance of what's going on. I just want to get your perspective on like why that is important, why you think that's going to be really good for the crypto blockchain tokenization industry, and I just want to get your perspective on that, man.
Yeah, well, I think if we take a step back, I think if we look at blockchain and cryptocurrency, I think they're two very different, it's one piece of technology implicated two different ways, right? And so I think the future of cryptocurrency is relevant and is important. I think equally or even more so is the importance and relevance of blockchain. And like I know a lot of companies that are experimenting with blockchain. I know a gold reserve that's up in Wyoming. They want to put all of their assets on the blockchain. And so I think, I mean, it could transform the real estate industry. So I think blockchain is a technology kind of like if you go back to the early 2000s and it was, pets.com and flowers.com. And it was like, wow, the internet. And our interpretation of the internet were web pages. Whereas like, I think for the layman, their interpretation of blockchain is cryptocurrency. But the depths of the internet was far reaching than just a web page. And I think the same will be true about blockchain over the next 20, 30, 50 years is we'll see it begin to integrate into every aspect of finance and really the whole economy. Specifically with crypto, I think it's an interesting story, right? It started as this kind of shady purchasing. This is what you use to buy drugs or pay off a hitman or use the black market. And now it's moved into, I mean, Trump's saying that he wants to have the US government hold a stake in it. And you have companies like Tesla that part of their balance sheet is in this. So it is becoming a far more relevant asset class. And we saw that last year with institutions beginning to hold it in a big way. But I think the story of crypto is a very interesting kind of organic progression from what's this new thing? How is that going to impact us? Ignore it. It's a waste of time and money to, okay, no, this is actually a viable store of value. Obviously, it's very volatile and, everything else like that. So is silver. If you look at the silver markets over the last 20, 30 years, extremely volatile, right? So I think it's an interesting thing. It's something to pay attention to. It is an asset class that is growing, and it'll be very interesting what happens when governments begin to hold this in large sums. So I think it's very positive for the crypto industry. I think the regulation needs to be kind of redesigned around it. And I think that was what really, I had a friend that was at that conference, got to meet with Trump, and that's what he came away saying, is that the regulation is going to be redesigned to better fit the asset class.
Yeah, one of the things, and we could always talk about like the philosophical things that are going on right now in regards to the fiat currency, the US dollar, and then versus
Sure.
like Bitcoin and stuff like that. But I want to dive deeper into more of like the application of this technology, the blockchain, the tokenization. And one of the things, and we were going to talk about here, is the importance of tokenization, because most of the time, definitely in the private sector, with really anything, in order to own a piece of real estate or own a piece of a business that is private, there's a lot of legal shenanigans that have to go on. There's agreements, there's operating, code. There's all these structural things that have to be established prior to actually owning an asset in the private markets. And one of the things is that's archaic and very kind of fragmented. And one of the things that I realized
Mm.
with tokenization, the importance of tokenization, is it democratizes the opportunity so other individuals can play that game that are private organizations. But also what I found interesting is it simplifies it, right? Because now there's a there's the blockchain, right? That is it's hosted on that obviously keeps track of all this tokenization. And just a very good example, just to bring it home so people understand, Lofty.ai. Lofty.ai is a really amazing or platform that basically there's real estate on there. Someone can sell portion of the real estate. So let's say, for example, a multifamily real estate, it's $500,000. They can take a portion of it, maybe 250, half of it, and they can put it on the Lofty AI platform. Well, now all of a
Mm.
sudden, people all over the world, they can buy tokens, which is like $50 per token, and now all of a sudden they can go in and they can buy a percentage of that asset. And they can get some of the revenue, some of the real estate income, some of the, all those things. Now there's some other things that you're not able to fully do in real estate, specifically in regards to like, being able to leverage depreciation. But there are other things that are very beneficial. But again, the reason why I'm saying that is because instead of being able to like lower socioeconomic families that aren't able to get a loan and buy a property, right, for a quarter of a million or half a million or whatever it is, now all of a sudden you can take a small percentage of your income, maybe 50 bucks a month or 100 bucks a month or 200 bucks, come in here onto that platform and buy a piece of that real estate, and now you own, or you can play in the game of real estate. Now that is just one application or one execution. I'm also seeing the tokenization in regards to larger privately held companies, operating companies, and say instead of selling it to a private equity firm, right now all of a sudden you can put it onto a
Mm.
platform, right, and sell it and say, look, to own a piece of this, so you don't have to go you don't have to go public, New York Stock Exchange, you don't have to sell it to a private equity firm, but you can democratize it, put it on this platform, and say, hey, look, you can own ABC company that's doing 3.5 million, $5.5 million EBITDA, and now all of a sudden you own a percentage of that company and are able to generate some alpha. And so I'm just curious in
Mm.
regards to like just the application aspect. Andrew, how do you see why one the importance of democratizing these asset classes, definitely in the private realm, to maybe people that aren't accredited investors, or maybe they are accredited investors, but it just gives them different access, and the importance of being able to increase the middle class, or giving middle class the opportunity to get access to certain things that otherwise they wouldn't have been able to get access to because it was just more of a high net worth, ultra high net worth investor access.
Absolutely. Yeah, I think it brings up an interesting conversation. And at its root, tokenization is basically converting the rights of an asset into a digital token that increases transparency and market access, et cetera, right? So it allows that fractional ownership. And I think you summarized it well with real estate. I think a lot of people would be familiar with um, fractional ownership of art, right? The
Hmm.
Mona Lisa, oh, I want to own, some art, but I don't want to spend $50 million on a Monet, so let me buy a fractional ownership of it, right? I think that's a really cool development that's happening. I think a limitation or a hurdle that needs to be overcome is one, widespread adoption, but also regulatory hurdles, right? Is this a security? Is it a hard asset? Like all of that needs to be sorted as we move into this being like widely adopted. The other point of bringing access to the middle class of these high end investments has been something that's been happening for the last 2, 3 decades, right? How do we bring the, your traditional middle class, the biggest asset that they own? You could debate whether it's a liability or an asset, is their home, right? And so, how does a non-accredited investor that has money stored away that wants to invest, how do they play in a world that's different than stocks, options, all of the stuff that is typically available to them that they may not have the awareness of, but they want to get into a private real estate deal or they want to get into owning a lot of this other stuff. There's a tremendous amount of regulation that prevents them from accessing high quality investments. The complete opposite is true for, the $10 billion bank. It's like they can invest in anything they want. There's hardly any regulation or oversight. You can leverage to the hill. You can sell that leverage to someone else, which we'll talk about shortly. But I think balancing that is something that is happening and will continue to happen through tokenization, where all of a sudden now is, a dentist that's a single working family. My wife takes care of the kids. We've got plenty of money, but no, I'm not technically an accredited investor, but I know a lot about art. Maybe my wife got an art history degree, and I really see the value in Monet or something else, right? It brings that person it empowers that person and brings them access to a marketplace that they really weren't allowed even into. You don't have the credentials, get the hell out of here kind of thing. It breaks that, right? And so I think it will be extremely powerful. And you see a lot of the crowdfunding platforms that haven't really taken off. There's been a few that have been successful, but it's saying, okay, well, let's have a regulatory assignment that says, well, we can raise money from non-accredited investors, and so we'll offer it up for 25,000 or five, even $2,000 or $3,000 investments into this real estate deal or this or that. So I think there's a huge appetite for it. My hesitation is that with a larger marketplace and you have 5 million people putting in $2,000 versus, 5 people putting in $2 million, there's the opportunity for theft, for fraud, for all of this kind of stuff. And so I think what needs to be addressed, and it doesn't replace the education that's needed for non-accredited investors. It replaces the access, but I think there's still going to be, like anything in the beginning, an opportunity for fraud or people getting into stuff that they shouldn't get into just because they have access to it. So I think it's a double-edged sword. Yes, now you have access to these investments that you didn't have access to, but do you really, it's the old, invest in what you know kind of thing. And when there's a whole menu of stuff, it's like, I don't really know if I like monkfish, but I've never had it before. Let's, it gives the opportunity where, I didn't realize I'm allergic to monkfish, right? And so I think that as that tokenization and fractional ownership of stuff comes into a broader market, it does not replace the need for education for lower accredited or non-accredited investors.
So one of the things that I found, just looking back on what you were saying, Andrew, in regards to, the double clicking on the fraud aspect. The fraud aspect to me is so important because, again, how do you verify in the public markets? You have a regulatory agency that verifies that you own a stock of a piece of company, right? Of a company. Now, in this industry, how do you verify that? You don't want to deploy it into a platform like FTX, and then all of a sudden you realize that they're using those funds inappropriately, and it goes, belly up. Now, I'm not saying in highlighting FTX is like that is going to happen all the time, but you just have to be aware, like you were saying, that that can happen, and unless we have some sort of regulation associated. But this is where I think is interesting between, in the political realm, where you see obviously the Biden administration becoming a little bit, heavy-handed versus obviously what Trump is saying. Now, again, we don't have any verification what Trump will say or what he will do, but what he's, what his proposal is versus Biden's proposal is it looks like it's a little heavy-handed versus more of laissez-faire or a hands-off approach. And what the context or the paradox a little bit is the crypto blockchain tokenization kind of industry itself is very decentralized. So it's not like one agency or one people or one group of membership are like regulating the industry. It's more of just it's a decentralized. It's a system where we're all kind of regulated, and that's what I find is extremely important. I think is also um, the reason why it's so important for that to be understood is because you don't need as much regulation. You don't need a outside regulatory agency to be regulating that because it is decentralized and the verification of it and the technology itself, and that's the importance of it. Now, I am curious, Andrew, when you're looking at when you're looking at obviously tokenization as itself as application, do you see it more benefiting the high net worth, ultra high net worth more of enterprise clients, the Black Rocks, the Vanguards, or do you see it more beneficially because again, it's democratizing opportunities that other people didn't have before? Do you feel like it's going to benefit more so the middle class, lower social economic class that are now given access and opportunity that they didn't have prior?
I think it's a crawl, walk, run answer. And so I think in the beginning, until it's widespread adoption, and let's go back to the regulatory moment for a moment. While I agree, it doesn't necessarily, in theory, need more regulation because it kind of solves its regulatory or transparency issue by having a digital ledger that's not repeatable and all of that. You do have currently two regulatory bodies, the SEC and FINRA, basically saying, oh, that's under my umbrella. And the other says, no, it's under my umbrella. And so I think that there is a fundamental break within the financial regulatory industry of the United States, that there is an overreaching, overbearing sort of, well, this is mine, this is yours. And so I think that needs to be sorted. I don't think it's sorted with no regulation. I think what would be smart is to realize that this is a different asset class, a different sort of beast, and let's have a new regulatory body that is specifically over blockchain and crypto that doesn't fall under FINRA and the SEC. Will that happen? I'm not sure, but I think that that would be a wise solution to that is to, I want people that are experts in blockchain and crypto regulating blockchain and crypto. I don't want someone that's a securities guy trying to, understand what's going on in blockchain and stuff. So I think it's the economies of scale, right? Like let's bring in the highest quality experts to be regulators and not the best regulators to kind of learn a new asset class. To the question of who will benefit the most, I think at first it will be the wealthy, the BlackRocks, the Vanguards, all of the mega players, right? Why? Because they have assets, and what's the initial value is its transparency and a record of things, right? But I think as it gets implemented into society, then we see basically the benefits expanding to other industries and just really the general public. Like if you put all of your cows on the blockchain and somebody has a disease or E. coli or something like that, and you can track all the chicken that came from the farm that had E. coli, that becomes a benefit to society where it's like, well, we know exactly where that chicken is because it's tied to the blockchain from this farm in Kansas, right? So I think as it begins to be implemented on a more widespread basis, not necessarily just from investing, but just from life in itself, right? Who benefited the most from the internet in the beginning? Well, the big guys that had the money to explore it and to use it and had a huge business to do it from. Who benefits now from the internet? Well, absolutely everyone, right? And so I think the same will be true for blockchain. Where's the testing? Where's the money? The R&D of how do I use this and what's it? But I think in 50 years, the world will benefit from blockchain because you know that the pair of Nikes that you're buying and it's getting shipped to, Kenya as the African market grows, you know that they're real, right? Or if I want to buy, a Gucci bag, but it's from China, is it really a Gucci bag? Well, yeah, it's verified on the blockchain, right? I think initially it was this meta world, metaverse, where I'm going to buy a pair of shoes, but I'm also going to get a token that is, the shoes for the digital world. I think that's a cool idea. I don't think people are going to be walking around with VR goggles anytime soon, right? So I don't see that as the implication. But I do think that the connectivity, the Internet of Things, right? You've got your fridge on the internet, you've got your Nest, like your whole house kind of is an orchestra that's all tied to the internet. If you do that to society, and maybe it's one example is, do I really need a real estate agent? Do I need to pay all of these lawyers for documents and the trust and like all of these things? I can verify. Okay, did you have any tax liens on you? Well, I don't know. Maybe I should get borrower's escrow or title insurance. And it's like, well, no, I don't need title insurance because I can verify that there are no other tax liens on this property. Things like that will impact where now there's transparency. There's not this unknown risk. So I think it could actually implicate or impact the insurance companies as well as every other aspect of society. So I think it'll first be with the large institutions, and then over time it'll impact kind of the globe as we know it.
Yeah, and that's what is so exciting. And I even look at it in a macro approach, internationally, where you have money outside of the United States, Europe, whatever, and there were
Right.
so many criteria, so many, fragmented approach to be able to deploy capital into the U.S. or vice versa, U.S. outside of the U.S. And I think that's extremely important because now what happens, and I've talked to numerous investor friends of mine, and one of the things that they always like why they don't deploy capital outside is one, the opportunity is not like really that amazing outside of the US. And then two, they don't know like there is no like repercussion if they lose their money. Like they don't know the legal system's not there,
Sure.
the foundation is not the establishment, whatever it is. And what by doing this now, having the tokenization and blockchain, you can own certain companies and you understand because it's the foundation is the blockchain and that approach, you know that it's verified and you're using these platforms. I think it's extremely important because we're seeing people that didn't have access to the US markets prior. There's a lot of money still, right? You're talking, Europe, you're talking Asia, you're talking whatever, and now they're able to own a percentage of the companies here, private, real estate, whatever, leveraging these platforms. And again, because the hurdle in regards to the amount of the tokenization, $50 per token or 25 or 100 or whatever it is, it's so minuscule that really anybody can play. Again, now just broadening that width of amount
Yeah.
of people that can play into the markets.
Right. Yeah. I think it. Go ahead. I think really what it does is the same way that now I can WhatsApp somebody in Prague at the touch of a button. It's connected the world, right? I can meet a guy in college and now he lives in Hong Kong and we're still buddies and we text all the time. I think it does the same thing, but for assets. It connects the globe in a more unified ability, and it drops some of the walls of access. So that's where I really think that blockchain and tokenization will like macro picture summarize it in
Okay. Awesome, man. And I think the importance and the power and the application we're going to see, and it's going to be very fun. And it's going to, I mean, I'm seeing some incredible opportunities out there, and it's going to be really interesting. We are at a precipice I mean, with AI and blockchain and the execution and the application of this, it's just going to be revolutionary, and it's going to be incredible to see the amount of wealth. I mean, who thought of content creators now, where how much money they make just for posting videos and stupid stuff and leveraging the internet? These people now, that's all they do, and they're perfectly fine. Are they extraordinarily wealthy? No, but now all of a sudden they have brands and personal products around their content creation. And I think it's just a whole other market that we have not even been able to tap into. And I'm excited to see that. I want to pivot a little bit in regards to, so we were reading an article the other day. Obviously, nearly 30% of VC deals are flat or they are leveraging down rounds. And I know there's a lot that goes on with that, the pros and the cons. Andrew, I'm curious, when you were looking at that data coming in just recently, we kind of anticipated that. There was already a lot of conversation around that. We already kind of
Yeah.
started seeing that tailwind and so forth. But I'm curious, what coming from here forward, what are the pros and cons for investors? Um, Definitely, and what I mean by that is investors that were in those rounds and now they have to take a loss, and then new investors that are actively allocating capital that are taking advantage of those deals.
One, I think it needed to happen, and two, I don't think it's the last time it will. And if we think about public markets and private markets as a similar beast, which is it's a live auction, and I've been an active market trader for the last 7 years, and well, more than that at this point. And the truth of the matter is, when everything's going up, like we saw the VC bull run from 2016 to 2019, like you couldn't lose. You throw money at any idea, and in 2 years you've doubled your money. The same was true with Tesla or Apple or any of these, like Nvidia is a great example today, right? So I think the question becomes, do you, for the investor that or the LP that's in this deal and has taken it down around, the question is, what is your conviction of this company, of this idea, of the team in the long run? The same way that, in the last 2 weeks, you've seen a significant downtick in public equities, and you go, okay, well, why is this happening? Because a month ago, everybody was saying how NVIDIA is going to, a $5 billion or $1 trillion company, and it can't be stopped. And we're selling shovels during the gold mine, and like all of the analogies of why this is a can't lose opportunity. And then it gets marked down 15% in a week, and all of a sudden the sky is falling. The question becomes, do you believe in the core technology and the company as it is? The second thing to keep in mind is, what's your investment horizon, right? I think a lot of people that get into venture, first of all, if we take a step back, venture capital is a great asset class. It's also one of the longest hold periods of anything out there. Its average hold of a venture deal is 10 to 15 years, right? So if you're getting into something like that and you know your investment horizon or how long you need to be in that is 10 to 15 years, and in 2 years you have a down round, as long as you believe in the company, you go, who cares? Right? Okay, NVIDIA is down, but I haven't made my 401k or IRA allocation this year. Like, what a great time to double down on the stock that I believe in for the next 10 years. So did it need to happen? Yeah, I think everything it needs to happen, right? Public and private markets is a live auction. And so when it's like, do I hear $10? Do I hear $12? Do I hear 15? 15? 15? Okay, 14. Okay, 13. Like, the market is always seeking active buyers or sellers. And so when you get to a point in evaluation where there are no more active buyers, you begin to look for buyers lower. And so that's what's happened at its root. Did the macro stuff change? Well, yeah, we probably knew. We all got kind of sleepy thinking that capital was going to be cheap forever. This is the new norm, 1% to 2% interest rates. Like, that's how it's going to be. I mean, I remember there was conversations about U.S. interest rates going negative like Japan. And everyone was like, oh, that's a high probability. And then 2 years later, we're like, geez, we're at 7-8%. And so does the market, does the tide shift without us being aware of it? Yes and no, right? I think you get used to it. And as human beings, I think we're creatures of habit. But is a down round in the venture space as a whole beneficial? I think absolutely. I think valuations were getting very out of hand and unrealistic, frankly, right? And so what did they do? They were looking for buyers at a new level. Um, Stripe is a great example. Stripe had tremendous support for it. It was a very high valued company, and then it took a down round of like 40% or so. It's still an incredible company. Yeah, it was at $95 billion in 2023. It had a round at 50 billion, so almost a 50% markdown in its valuation. Has it rebounded since then? Yeah, absolutely. And they're looking to do an even higher round. But like, did the valuation, did the market need to kind of take the legs out of some of these companies? I think absolutely. If you also look back to what's changed and what hasn't rebounded is the SPAC industry. The SPAC market was bananas, and now a lot of those SPACs that listed at $10 that went to 12 or 15 are trading for pennies. And so I think it's the beauty of capitalism is like, sometimes stuff goes up and you don't know why, but it doesn't stay that way. And so I think there was a necessary purge, and that's innovation, right? Everybody, you create all these things, and not everything's going to work, but for a moment you think it will. And so I think the down round in venture was very healthy for the market, and the future of that, especially. It's interesting that the down round coincided with AI being released to the world and being implemented, right? I see that as very exciting. And so now you've got this kind of pause where you can reassess your company's books, your LPs, you can structure some different deals that have you, if I'm a venture fund and I'm going, if I'm Stripe and I'm at 95 billion and I get cut down to the next round's at 50 billion, I go, okay, and I look at all my LPs and I go, how long are you guys in this game? Because if you want to get out, get out. Like, I'm growing this company for a long time. You know that venture is a long play. So like, if you're with us, you're with us. Now let's implement AI into the company. And so I think it's a very healthy cycle within venture. And I'm excited about the next 10 years of it because I think you can get some great deals out there now. And the companies themselves have had time to pause, reflect, and kind of whether it be pivot to a different business model or really find what business model is the true revenue driver within their firm and focus on that. So I think it's been very healthy versus just, popping champagne and higher valuations. When is the core business really operating well? Do you have a lot of wasted money? Is this business unit even worth keeping? I think it raises all of those questions for venture companies, and it poises them well, cuts the fat for them to grow in the
Yeah, it's
future.
another case of, bad timing. And what I love about it is nobody likes it. Definitely when you're in
Yeah,
the fund and you're seeing these amazing valuations and you're like, man, I'm
sure.
winning, I'm winning, I'm winning, I'm winning, right? And I even saw a lot of founders, right, where they started, uh, you know, 18 months later, I mean, their valuation is, 75 million. And it's like, on what, right? And they're pre-rev. And the thing is, the valuations were just such astronomical situation where it wasn't even like viable. It was like, okay, guys, and their identity was stuck in it, and they had like a lot of these founders were like psychological messed up
Yeah,
after the valuation drastically decreased, from 75 million to like it's only worth 10 million or something like that pre-rev. It's like, well, of course, man, like what do you think you were getting into? And so you just saw like huge situation of just another case of like just crazy markets, easy money, cheap money, just available. So might as well take advantage of it. And you're exactly right. One of the questions that I always were asking is like, was it an actual logical valuation when we were seeing that, or was that just a bloated valuation? And that was not the actual true valuation. We say it's a down round, but the reality is this round, the valuation now, is that the actual financial stability of the company? And that to me is what I'm seeing in industry. in the market, and the market has gobbled that up and accepted that. There was a difficulty where a lot of the employees or the C-suite or whatever the other people that are on the cap table, they wanted to sell their position at that higher valuation, and then there was this delta of individuals that were looking to buy. But the thing is they were not willing to buy at that older valuation. They wanted that valuation to come down. So for a long time, you saw the markets were kind of just stagnant until all of a sudden the sellers were just
Hmm.
like accepted the current valuation. And that's tough, right? Because definitely on your balance sheet,
Right.
on your financials, it's like, man, we're taking 70 cents off on the dollar cut, right? Well, that sucks. It's horrible, right? But at the end of the day, this is the actual true valuation. And now we're seeing the market gobble that up. A lot of individuals are selling at a discount or obviously down, and that's just how the market is. But as individuals that are got dry powder, right? And we're seeing Apple, we're seeing Warren Buffett, we're seeing these large companies, and I think it's going to even get even worse. I hate to say that, but I do think that it's going to get worse. What we're seeing that you're not able to the strategy, and I was talking to someone else, the strategy in venture capital, it's not this, hey, we're going to burn at all costs, right? Because there is no like guarantee
Mm.
that, hey, look, we're going to burn through this round, we're going to go over here and raise another round of more, and we're going to burn through that cash, and then just this grow at all costs. Now it's this strategy and the structure of, hey, look, we got to grow, and we got to put the constraint in and saying, what if there is no bridge round? What if there's not another way where we can raise another $50 million, right? What if we're just stuck with this amount of money, and we got to start saying, how can we become profitable? And so I think that is a good constraint because now you're building a healthy business. Now you're building a sustainable business. And I think that's
Exactly.
actually really important for the markets. And a lot of people look at this and saying, because again, this is the thing that venture capital and and like the founding team, it's it's a dichotomy a little bit because venture capitals, because to return back to their investors, they want to make sure that the valuations have drastically increased and bloated because again that looks good on their financial statement, the balance sheet, right? And it's good for their investors, right? Hey, within look at our valuations for the companies we've invested into. Founders doesn't mean that that's always the best thing because you and I, Andrew, we've seen where companies are $20 million revenue, right? But the thing is they're not profitable, so their burn rate is just like crazy, and the reality is like, okay, you're cash
Right.
flowing, but you're not actually, you're not cash flow positive. And there is a huge, massive differentiation behind that. And is that a healthy business? I would say no, right? And I think that's extremely important to understand that. And that's the dichotomy between an investor that's looking at just increasing the valuation versus, hey, look, a founder or the founding team and saying, look, hey, we want a healthy business, we want a sustainable business. And I think that's very interesting to see right now. And there is a fight right now that's going on.
Yeah, I think investors, VC funds, I think they got lazy. They had such like consistent success. And so all of a sudden there's a very short checklist of, are you creating revenue? What's your growth? Do I like your asset class or like the market that you're in? Rubber stamp, I'm investing. Like, very lazy. But at the end of the day, if I'm spending $2 to make $1 in revenue, that is not a sustainable or a good business. And but if you're a founder and you're like, well, heck, man, we can raise another round if we just spend $2 to make $1 revenue. Let's go do that. And we're getting this higher and higher valuation. I think laziness begets corner cutting. And now that's not the case anymore. And so the VC funds have a much deeper dive into the company, and it's creating healthier and stronger companies. Not everyone should win. It's the honest truth, right? Not everyone should get a medal or a gold star because they participated. And so that's what I think was happening. If you've got a company, you want to throw AI at it, boom, your market just like that should not be the case. It's not a healthy market. And so I think people got burned, but I think in some ways they probably should have gotten burned because if I'm just investing based on, okay, it's post revenue, it's in a market and field that I like, and the team's a second time founder, I'll write him a $20 million check. that's lazy investing. And so that's what I think has drastically changed. But if you look at these VC funds, they are very picky now with what they're investing. That's good. I think that's good for the marketplace. It's good for the future growth of the venture world within the US is not everyone's winning anymore. And the companies like Stripe, they get marked down 45%. Stripe's a great business. And so the winners will come through it. I think the losers never should have been at the valuation that they are. They'll get taken out, they'll get gobbled up, their tech or patents will be bought by someone else. Not everybody should be a winner.
Not everyone should be a winner, right? There's got to be losers, right? There's got to be a gold, there's got to be a bronze, there's got to be a
Yeah.
silver, and everybody else loses, right? And I think that's extremely important, you know. And you're right. Nobody likes to lose, but that's the marketplace, and that's capitalism at its finest. And I think that's incredible.
Yeah.
Let me ask you this. So we're going to dive into this a little bit because I think this is extremely important. Debt, how much debt is too much? Right now, we're seeing, and we were reading this
Yeah.
article. Ares Management, $35 billion they just secured for its U.S. senior direct lending strategy. HPS Investment Partners closed another giant round of like about 21 and some change billion for its flagship security loan fund. Goldman Sachs, Citigroup, Wells Fargo, they're anticipating to also raise about 50 billion to capitalize on the strategy of credit lending and debt. And the strategy really, and overall, the private debt assets under management has risen more than $1.6 trillion and over dry powder of over 500 billion. The reason why that's so important with the market is because the only reason why a company has to go and get some debt is for operational income, right? And also the reason why is because
Mm-hmm.
that shows to you that something's going on in the market, that they can't rely on client income as an income, and so now they have to go and get either debt to as operating or debt as in to grow their company and buying more assets, etc. Now, what I find very interesting about this, and this article that touched much on it, but in the debt, I've looked at some debt funds, numerous debt funds. One, it's a good income strategy for investors. Deploy $1 million and you get a nice 7, 9, 10% yield on it, quarterly dividend. Wonderful. It looks amazing, but at the end of the day, you also have to acknowledge that your strategy is drastically different. It's not like private equity where you're trying to generate alpha, or it's like real estate or anything. It's to say, hey, look, it's a sustainable income. It's a good yield comparatively. But the thing is, with a lot of these funds, the criteria is extraordinarily, uh, really filtered. And what I mean by that is I've seen some where the LTV, loan to value, has to be roughly about 45 to 50%, meaning that if you own debt of up to like 70, 80% on that, they won't even look at that opportunity. Also, I understand that one of their criteria is, hey, there has to be roughly about 20 to $50 million EBITDA businesses in a specific industry, and they make sure that they have to have some sort of hardware or hard assets that they can lend upon. Now, there are some other opportunities where I've seen where they are willing to lend upon IP or lend upon other different assets. But the thing is, a lot of times they gravitate toward more hard assets, mainly because that's something that is that they can actually underwrite. So my point is when you're looking at these funds, it is a very, very filtered criteria before they actually deploy capital and work with them. And I just think it's extremely important because this article showed the hunger and the demand for debt and more of a credit approach compared to that typical equity or asset play. Well, Andrew, when you were looking at this macro trend right now, and as an investor that we're working with numerous individuals, we're seeing that they are constantly allocating or increasing their portfolio structure toward this. Sometimes it might have been 10% of their portfolio construction. Now we're seeing them kind of increase it to like 15 to 20%, just because of the macro trends. So I'm just curious, when you're talking to some of the investors and obviously underwriting some of the deals that we're looking at and so forth as Pax Fortis, what are you seeing and how do you think this is uh, beneficial for the trend that's going on?
Frankly, honestly, it concerns me. I think debt is a scary beast in the closet that we all hope won't come out. I think this all started with Basel III and kind of changing and shifting the regulation, stronger requirements on traditional lenders and big banks. And so the private market jumped on the opportunity. And I think that's great. What concerns me is the just it's very easy to get over levered. And one of the days that's going to all come crashing down, right? And we go, well, I hope it's not today or tomorrow. But I think the amount of debt out there is concerning. And you know, anybody says the amount of debt is concerning you, I immediately think of the U.S. government's debt, right? It is absurd and it's ballooning. And it's always this let's kick the can down the road. When we talk about a VC company, a growth company, a tech, deep tech, or healthcare, or something like that, debt is a necessary beast, absolutely, right? But it can get, when you get to scale, if I raise $50 million and I lend it out, and then I borrow against my loans and I get another $40 million, and then I do the same thing, it's very easy to become this like uncontrollable beast that has no one really knows how big it is. That's the biggest part that concerns me, because now it's shifted from this public, large publicly traded companies, the JP Morgans and that, to these private markets. No one really knows how much debt is out there. That's concerning to me. So I also don't think that we're ever going back in the near term to the cheap interest rates that we had. I think that's gone. That'll be a moment when we're old and sitting on a boat somewhere. We're going to. Can you believe that debt was only trading at a point 2 points or so? Like, I think that is a something of the past. And so how do we get used to this new normal? There's massive opportunity, right? And so PE funds are raising billions of dollars that's going out and making these loans. That's great. But at a point, everyone becomes so intertwined. It's like the 2008 crisis, right? You've got all of these loans on homes, and then I'm selling those loans to someone else, and the synthetic of that, it just becomes, you can take, $1 billion or, $50 million, and it creates $1 billion worth of money that's betting on it or has some sort of connection to it. So I'm someone that looks, when I'm underwriting a company, I do not want debt to be part of the business model, a part of what helps them, that really without it, they couldn't grow. Without it, it wouldn't work. Yeah, it's extra cash, it's extra firepower to expand hiring or to do R&D or et cetera. But if you take the debt away, what's still there? And for me, the question becomes, if you're underwriting a company and you take the opportunity for debt off the table, what is left? Is it a profitable business? Is it a good piece of technology? Is it defensible? So when I underwrite a company, I obviously debt, you're not going to run away. Oh, you got debt. I said, no, absolutely not. But what I don't want to see is that without debt, we can't grow. Without debt, this business model doesn't work. That is extremely concerning for me. That goes into the no column when I'm underwriting a deal. So I want to see a company that uses leverage, that uses debt to grow, but it's not the necessity. It's not the only thing that's helping them, get to the next level. It's got to be a core business without it. And so I think there's a difference there between everybody, the average investor. If we go back to the not accredited investor and the home being their largest asset, which is also their largest liability, how does someone go from lower middle class to upper class? It's using leverage. Everyone knows that, right? But can that get out of hand? 100%. And so really I'm less concerned about, I think it's easy to tell when a venture company is too debt hungry or debt laden, right? I was doing diligence on an RIA network, and they have a lot of debt on the books, and they've got a lot of growth as well. But without the debt on the books, or without the debt that they've had over the last several years, the business wouldn't survive. And so that's a no for me, because all of a sudden it says like, well, what are you without this, right? So that's, I think, an easy litmus test you can have is analyzing the company, strip away the debt, what is left. If that's a solid business with growth and a team and defensible assets, okay, well then let's make sure that the debt matches and it's a healthy pairing. Where I get concerned is the lack of transparency of how many billions and billions are betting on these companies, and now I've sold that debt to somebody else. That's what gets concerning to me. I'm not at a position to be able to regulate that or to really have an insight to that. But when you talk about this new market where private equity companies are saying, hey, I'll lend you for 12 points, like, you know, I think there's a lot of money to be made there, right? Where does that go wrong when there's a lot of money to be made and a lot of money wanting to play in that space? Things get shady, and you can over leverage your debt fund, and now you've got debt on top of debt on top of debt on top of debt, and you can have a cascading effect that if something goes wrong, it is a massive global issue, not one venture company goes belly up. So I think there's two stories there. One, it's a venture company that only grows because of debt, and the business is not sustainable, isn't good. Again, I'm taking on debt to buy $1 worth of revenue, right? I'm borrowing $2 to make $1. Bad business. That's easy to kind of see. The macro hard to see is, well, how big is the beast under the bed? And that's what concerns me in the future. I don't know where that will play out, or how that plays out, but when we talk about now PE being the main source of lending for middle market companies, how does that go wrong? I think it could go wrong in a very big way versus a small way.
Yeah, it'll be interesting to see how the market obviously is able to gobble that up a little bit, because there are obviously, that is, when you're seeing such demand for it, there that is a kind of a red flag for the economy, but also saying, okay, well, there's good opportunities for investors, right? So those that are sitting on dry powder, because at
Sure.
the end of the day, so like, you were talking about the one that you were underwriting with the RIA, we were underwriting another one where the opportunity was basically, so in fact, I'll share the notes here real quick. I won't say the company, but what they're doing is their home services roll up in Florida, set for a quick turnaround and solid return. Um, they're seeking about 16 million to complete this roll up strategy. They're due to the key highlights of the metrics is 2x return over 24 months, dividend yield, which is, of course is the quarterly, paid out annually or quarterly, 7% with a potential IRR of 46%. The reason why we actually decided not to pursue that, after looking at it, in depth and thoroughly and so forth, was because one, for the amount of alpha that could be generated from that structure, it wasn't worth the debt approach. Plus, the 7% isn't really that much compared to some that I have seen, definitely in the debt approach and the credit approach, where it may be 9, 10, 11%, and that's really good. And that's kind of on the lower side. I've seen some, but also one of the things that I found the
Yeah.
opportunistic aspect behind the credit approach is a lot of times it's a non-liquid, right? Where you're not in that situation for 17 years, right? You're not, you are 2 years max, maybe 3 years max, be able to turn the money around pretty quick, be able to deploy it very, very effectively back into another asset and so forth. Andrew, you and I we're talking to a friend of ours that runs a single family office. She's worth about $500 million, and she's huge in the credit space right now. And I was talking to her a little bit, and one of the reasons why is because one, you know, there's a huge demand for it. Two, when she's underwriting it, she's like, look, just like you were asking, Andrew, like she has to really dive deep into the other financials. What is the loan to value? How much other loans are on this company? And if she is going to loan out
Yeah.
and a credit approach, then what is she backing it by? Is it hard assets? Is it IP? What will she get and so forth? And there's a very, very structured criteria before she decides to, and probably 90% or 95% of the deals she just says no to because it doesn't fit her criteria. But I do understand as an investor, when you're looking at the credit space individually, then I think it's extraordinarily powerful to be able to say, hey, look, we have some consistent income, much more income per se than real estate would provide at this point because the terms are so sexy. And that's what I find so interesting about the markets is when there is this delta between the supply and demand aspect. When all of a sudden, when these companies are looking for it, as the as the buyer, you have more you have more ability to determine and get better terms for your side. And I think that's extremely important. So there's a really good opportunity, but a lot of times as Pax Fortis Family Office, we tend to stay away from it, mainly because it's good opportunities.
Yeah.
And not saying that it's not, it's just that our strategy is looking for, okay, more of asset appreciation, more alpha generation, things like that, that would be able to, we can come in and say, hey, look, we can come in and uh, really underwrite this company, but also see a huge, huge upside potential. Now, Andrew, I'm just curious when we're, as the CIO of our family office here, when I'm looking at a company, whether they're doing like we were looking at one the other day, $20 million top line, or whether one's doing $2 million, $3 million top line, I always look at safe agreements and debt as a huge underwriting yellow flag or red flag. It's not a red flag like I'm going to say no to the opportunity. It's just more questions I have to understand. Um, what kind of debt do they have on the books? How much? What's the loan? Um, what's the loan terms? What does that look like? Is it a specific bank? Is it there's just so many questions I have to unpack when I'm looking at it. But I will tell you when I'm looking at a company and they have a lot of debt on the books, then that is worrisome, right? I would rather them dilute it, dilute their equity, raise more capital in an equity approach, more so than coming over here and getting more debt on the books. I'm just curious when you're looking at these companies, Andrew, and I know we're kind of getting off from the debt side, but I think it's important to understand how we think about this and approach this, definitely when we're underwriting specific direct deals. What is the importance and the weight that you put on the debt on the financial statements of these founding companies?
Um, I think it's short answer. It's a tremendous amount of importance. I think a more detailed answer is it depends on what stage this company's at. I think there's pros and cons of both, right? If I have a great company and I know it's great and I need some operating capital, but I know I have a great company and I don't really want to give up my equity and I want to bring in a debt partner. I think that can be a positive story of I understand it as a founder. You've built this great company, you put your sweat equity in, you want to maintain a 30% equity in the firm because you're the founder, bring in an equity or a debt partner. Um, the question is it a solid company, right? And so I think a lot of times when I'm underwriting a deal, it's challenging to hear the story, see the financials, and really dig past everything that you've been told or heard, or the founder's perspective of the company and the story and why we did this, why we did that, and just look at the hard numbers. That I think is the root of all diligence is hearing and taking in the story and the color and the context, and then kind of throwing it in the trash and really looking at what is the company, what are its assets. If we go back to debt, I think these levels of 4 to 5% interest rate on Fed funds rate is a very healthy place for the market. It was not healthy when you couldn't get 2 pennies to lend somebody money. It's just, yeah, you can buy a cheap house, but like you're not getting yield. So I don't think that that's a healthy place for our economy to be. I think in the 4 to 5.5% range of the Fed funds rate is a very healthy place for the economy to be, because it opens the doors to, I mean, 2019, 2020, people were signing some ridiculous investment documents with a whole lot of risk, opportunity to lose all of my money, but I'm getting the 7% yield. Like, where else am I going to get that? So it puts, if we go back to the unaccredited investor, it puts them in a pickle, because now they can't get any return for their money without taking an exorbitant amount of risk. So I like the marketplace that is in that 4 to 5.5% range. When underwriting a deal, I say no to something that's a debt deal a lot of times, because 8 out of 10 times the collateral isn't really collateral. I mean, maybe it's a healthcare asset in Western Pennsylvania, and you go, oh, well, it's collateralized by the land. But it's like, what kind of market is Western PA for a property? Like, so I think when we dig into it, the founder of a company that wants to have debt is like, look at all this collateral. And it's like, well, that's great, but it's not really worth it, right? So when you look at a company and say, hey, I want to raise debt, or I want to raise a safe route, I think there can be a good and a logical reason for that. I've got a great company, I've got a lot of equity partners, we're rocking and rolling, I need some debt to expand, or I need some debt to buy out my competition, and the company's going great, kind of thing. Okay, that's a story. Again, let's throw that all in the trash and look at the numbers, but I can get behind that. If it's, I got this great company, I don't want to get up my equity position, I'm only taking on debt, and it's a core kind of mentality of the founder, and when you dig into the numbers, like, this isn't that great of a company, then it becomes problematic, where it's like, this guy's delusional, he thinks he's got a golden goose. That's going to be a no. The same is true for a safe round. If I was to say, I'll sell you my house, but I'll give you a 20% discount to what the market rate is, how much do I believe in the value of my house? Probably 20% less than what it's trading for. So I think a safe round is indicative of founders and the team going, we think this is a good deal. We think that this is a growth company and a viable company, but like, we're not sure, our investors aren't sure, so let's do a safe round. So I think a safe round is a good yellow flag, because if it was the hottest, sexiest new company, why the hell would you be given a 20% discount? Now, again, it depends on the stage of the company. If the stage of the company is very new, very young, has a great team, a good vision and product, I can get behind a safe round, because, hey, there is a lot of risk here. But if we're in a seed round, that's like angel kind of pre-seed kind of stuff. If we're in a seed or an A, God forbid a B, and we're doing a safe round, it's like, what's the problem here? And I think it's indicative, it's a band-aid that's like, hey, come invest in us, you get a 20% discount. And it's like, why are you in a position where you're having to offer that, right? In some ways, it's an on paper down round. Like, if my value of my company is at 100 million, but I'm raising money at a 20% discount, is that not really a realistic markdown of 20%? So what's the deeper story here, right? Are you mismanaging your use of capitals? What did you do with the capital that you raised in the last round? Did you spend it on business units that aren't profitable? So I think those are really important things to note, where years and years ago, I would see, oh, it's a cool company and it's 20% discount, like, good for me. But if you get beyond that to say the psychology of why is this being offered, what I want is a company and a founder that says, don't want debt, I got a great company, I'm willing to give up some of my equity because I know I need partners to grow, and here's the valuation. It's like, okay. Again, you throw it in the trash, you look at the business, but that's more indicative of someone who truly believes in what they've built. There is value on the bone here. I'm not going to just sell it to you. I'm not going to, sell the farm per se because, or give away the farm because I need some additional capital. So I think it's a very good picture into what's really going on here. Hey, we got a 2019 Corvette and it's 40% below market value. It's like, what a great deal. It's like, well, like maybe there's water damage. Like, why is it 40% off? And so I think the structure of an offer from a founder is very indicative of the health of the company that goes beyond the story or what they're saying. And I think those are good things to take in as we dig into the numbers. As that's what I use to when I'm underwriting a deal is to hear the story from the founder and explain everything, but also what is being offered, the structure of what is being offered is a very good indication of the health of the company.
Yeah, and I know one of the biggest assets that we bring to the table as Pax Fortis is, like you said, and just double clicking on this and footstepping on this, is the context. Right? We are not, when we're looking at underwriting, it's not like this very strong criteria where that's a yes or that's a no. It's more of saying, okay, well, that's a red flag or a yellow flag, and then diving deeper into it and understanding and building context around, okay, why do they have so much debt? Right? We were just talking about where this company's been, they raised $60 million. They've been open for 10 years, and they're $20 million top line, but that is a concern, right? And they don't have on their cap table. It's very reputable, incredible people on there. We and we're looking at their debt and what's on their balance sheet and their financials. But I think it's extremely important, like you said, where okay, we got to build context. And like even when you're looking at like okay, the safe agreements when they're on a discount, why is that? It's not a yes or no. Oh my goodness, whatever, right? We don't want to take it. We just say okay, why is that? And unpacking that and saying okay, is there validity behind this? Are they just doing it for a bridge, just to bring some capital in? Um, or is it just saying, okay, well, that is a concern. And like you said, when they don't have conviction in their own company and they're doing all these crazy discounts, you know, why is this motorcycle 30% off, right? On the side of the road? Okay, they got some water damage. It's been a whatever it may be. And like you said, I think that's one of the reasons why. And I've known like a lot of the families that we've worked with and invest alongside, that's something that's extremely important is then okay look, let's just build context around it because then that mitigates our risk of missing out on an opportunity because if we have such a deep setted
Yeah.
concrete criteria, we do have a criteria, but if we have such a deep setted, then we miss opportunities that otherwise we wouldn't have if we would have just dove deeper into it to build context and understand. And that's where you get the true winners in life and true winners in this
Yeah.
game is saying, hey, it's not first time founders never ever invest because otherwise you would have missed the opportunity with Mark Zuckerberg. And that's a beautiful example, right? Or Jeff Bezos, right? So here you can't just say that that's the criteria. Or like you said, hey, they have too much debt on their books. Okay, they may have, but also unpacking that a little bit further. Maybe there's a letter of intent of a big enterprise client that's coming in and they've already got the capital and it's just a matter of they're going to deploy and they're going to wire the money, right? And all of a sudden it builds context, and some of that money is going to be, paying off those debts. So again, it's sitting there and saying, okay, well, let's look at this on a time horizon. So, and those examples that I gave, those aren't fictitious. Those are real things that we're looking at that are actually real happening. And I think it's extremely important, and it's a superpower of ours. Andrew, man, this is a good conversation. And for those that are listening,
Yeah, it's been a pleasure.
yeah, it's been awesome, man. And so let me ask you, Andrew. Obviously, our last few minutes here. Any other last little bit of words that you want to add on to that we didn't cover?
No, I think we covered a lot of stuff. I think the debt is something to watch. I think the U.S. economy and what happens in this next election cycle will very much dictate where the markets go for the next 4 to 10 years. And I'm excited for the growth of venture capital. I think the down rounds were honest and needed to happen. And to go back, you can't have everybody be winners. And the truth of the matter is that I think everyone became winners because a lot of underwriters got lazy. And I think sometimes you see that now, but on the other side of the spectrum, where I have this list, instead of this list of yeses, and if you check all the boxes, it's a yes, it's I have a list of no's, and if you're any one of these, you're an automatic no. And I think that that's laziness on the other side of the spectrum, where, oh, you're not a first time founder. Nope. Now, does that save you from some headache and losing and this and that? Yeah, sure, right. But at the end of the day, it becomes a fear of, I don't want to lose, or I'm only going to bet on these guys. But if you are these, well, hey, I only invested in a second time founder, and so don't blame me. So I think at the root, we have to get our hands dirty when we do the diligence. I think great equity investments are done looking at spreadsheets and talking to, one of the things we always do when we're underwriting a deal, we'll start with meeting the founder and hearing the story, but we want to talk with someone else on the team without the founder present. Hey, you're an equity owner in this. You kind of gave up a different job. You're working here full time, basically for sweat equity. Why are you doing that? Why do you think that that is a good way to provide for your family? And hear that from them, because that's where you get a lot of the honest truth, whether it's good or bad or great. It's really a second stage of our due diligence process. And the third stage is to speak with some other person on the cap table. Why did you invest? Why have you believed it? Here's my questions. Do you have answers to those? Are you educated, or did you just kind of buy this hook, line, and sinker? Do you really validate this investment, or were you the lazy investor that said, "Hey, check these boxes, so I invested"? So I think the future of investing and venture specifically is in the nitty gritty due diligence, and that's really what we bring to the table with Pax is we roll up the sleeves and get dirty when it gets into the due diligence of stuff. So yeah, I'm excited for our future conversations. Thank you for everyone that's listened and joined us, and be on the lookout. If you know us, then we may have some great deals for you.
Awesome. Always a pleasure, Andrew. Chat soon, man. Cheers.
Bye. Thank you.